Hey guys, welcome to Cult Research. I hope you like our new set. We're trying something a little different today. Guys, passive income isn't what you think. The modern world is full of uncertainty, and a lot of people are desperate to find some kind of stability. Over the past 2 decades, we've seen periods of high inflation, one major recession, and a close call during the pandemic, record breaking company valuations, and a historic shift in labor dynamics. Though prices have soared, average wages have stayed relatively stagnant over that same period. This has caused one idea to take root in our collective imagination: passive income. Now, the concept is pretty simple: money that earns itself. Rental income, dividend based investment portfolios, royalties, digital products, affiliate marketing, the list goes on. These strategies flood the financial corners of YouTube and TikTok. They present a path to freedom from your 9 to 5, claiming to offer quick and easy ways to make your capital work so you don't have to. But this idea, passive income, it sort of fundamentally disagrees with the complexities of real life. Most passive income strategies require a fair amount of risk, a lot of time, and far more expertise than people realize. Most aren't even truly passive. And more importantly, in an era of rising capital costs, shifting labor capital dynamics, and lower expected returns, the economics of passive income are changing beneath our feet. Today we're going to break this down: what passive income actually is, why the strategies are a lot harder than advertised, and what the data says about those who really benefit from these models. But before we get into it, I'm going to ask you to hit that like button and subscribe. It really helps out the channel, and even better, it's totally free. So to understand why the passive income narrative is so powerful and so persistent, we need to go back to the post-World War II era. In the mid-20th century, the American dream was underpinned by a clear formula: work hard, save diligently, retire with a pension, and earn steady returns from low-risk investments like government bonds and blue-chip stocks. Between 1945 and 1980, wages grew with productivity for the most part. A middle-class household could own a home, fund a 401k, and still generate meaningful retirement income from modest investment portfolios. Dividend yields on the S&P 500 hovered around 4 to 5%, and US Treasury bonds routinely yielded a real return somewhere between 5 and 7% throughout the 1980s. In this context, the concept of passive income wasn't that foreign of a concept. It was mostly structural. A 60-40% portfolio, that is 60% equities, 40% bonds, could generate reliable income streams without much active intervention. But the macroeconomic foundation that made this possible started to erode in the 1980s. Deregulation, globalization, securitization, and a long march toward lower interest rates fundamentally altered the relationship between labor and capital. As real wages stagnated compared to asset prices, this investment strategy started to become more out of reach for the working class. Long-term capital gains replaced consistent, steady cash flow, and the passive income many had come to know became harder to access without significant upfront wealth. By the 2000s, passive income had become more aspirational than guaranteed. It wasn't just a strategy, it was a lifestyle brand. But that branding often obscured the fact that the old model of set it and forget it income generation no longer applies in the same way. Here's the uncomfortable truth about where we find ourselves today. I would argue that there's really no such thing as truly passive income, not in the long run. Take real estate, for example. It's often held up as the holy grail of passive income, but landlords have quite a bit more to deal with than some people realize. While you may see the side that involves passively collecting rent, it's easy to ignore that they're also dealing with property management, maintenance costs, regulatory compliance, tenant turnover, rising insurance premiums. The list goes on and on. Even with a great property manager, the investor carries financial risk, legal exposure, and market volatility. But what about dividend stocks? Sure, they can pay you quarterly, but to build a portfolio that pays out $50,000 a year in dividends at a 3% yield, you need nearly $1.7 million in invested capital. And I can't tell you the last time someone was willing to lend me a cool $2 million. But even if you manage to secure the required capital, that portfolio still needs to be monitored, rebalanced, hedged, and optimized for capital gains taxes. But what about digital products? Think ebooks, courses, YouTube channel monetization. These can generate long-term revenue, but they require a ton of upfront creativity, ongoing promotion, SEO optimization, and platform management. Algorithms change, audiences shift, content decays. Even royalties from creative works, books, music, patents, they require intellectual property protection, marketing, and legal oversight. There's a process of labor that precedes the passivity of it all. Economists refer to this modern-day interpretation of passive income as the myth of capital elasticity. The assumption is that capital produces income at a constant, effortless rate, but that idea falls apart under even the most basic analysis. Most of us would agree that running a successful business takes capital, strategy, and constant adaptation. Yet when passive income strategies are presented to us, something shifts. We suspend that logic. Suddenly we believe we've discovered this amazing loophole, like we're on some secret shortcut to wealth. But the truth is, there are no shortcuts, just different forms of work for most of us. And that's the trap. What's labeled as passive income is often just front-loaded. It's labor-intensive early on and only later converts to recurring revenue, if everything goes right. But the survivorship bias is massive. For every course that generates $10,000 a month, thousands of them sell zero. For every rental empire, there are hundreds more that default and face foreclosure. And here's where things get especially ironic. A growing number of people online who claim to teach you passive income, I'd argue that they aren't actually earning it the way they say they are. Their real passive income strategy is selling you the passive income strategy. They package your desire for an easier life into a $600 course or a paywalled Discord community, and that becomes the income stream. They're not profiting from real estate or dividends, digital products. They're profiting from your belief that you can. And in doing so, they've created an ecosystem that monetizes aspiration more than execution. The dream of money while you sleep still demands that at some point you are wide awake, alert, and deeply invested in the process. Even if a passive income strategy is well designed, it still exists within the same macroeconomic environment that any idea is at the mercy of. And as we've been talking about more recently, that environment today is far more difficult than in past decades. Let's start with interest rates. For most of the 2010s, the federal funds rate hovered near 0%. That pushed investors into riskier assets in search of higher yield, stocks, real estate, crypto, startups. But in 2022, the Federal Reserve began one of the fastest hiking cycles in modern history, taking rates from 0.25% to over 5% in less than 2 years. That shift has massive implications for passive income strategies. First, higher interest rates raise the opportunity cost of risky ventures. Why build a dividend portfolio when short-term treasuries now yield a risk-free 4.5%? Second, higher borrowing costs crush the economics of real estate investing. Mortgage rates have more than doubled since 2021, with 30-year fixed rates hovering around 6.7%. That significantly diminishes the likelihood of sustainable cash flows, especially for leveraged properties. Third, inflation complicates cash flow expectations in general. If your income stream isn't inflation adjusted, like if you have fixed annuities, low yield bonds, or flat rent leases, your purchasing power is declining over time. A passive income of $5,000 per month isn't the same when core services and groceries are rising at 4 to 6% annually. Then there's asset volatility. 2022 saw both stocks and bonds experience extreme drawdowns. Even traditionally safe passive income vehicles like REITs and dividend ETFs suffered double-digit losses. Since 2023, we've obviously seen massive growth, but there's evidence that we might be in the middle of a pretty significant correction. And while some argue that diversification protects against these shocks, the truth is that the correlation between assets tends to spike during crises. Or in other words, diversification can protect against unsystematic risk, but does very little to protect against a systematic decline. In short, the macro environment is no longer accommodating. The tide of easy money has receded, revealing just how difficult it is to engineer reliable, inflation-resistant, risk-adjusted income without deep expertise and constant recalibration. But it's also worth asking, who can actually live off passive income? Well, the answer statistically is pretty clear: the wealthy. According to IRS data from 2023, approximately 85% of dividend income, capital gains, and rental income flows to the top 10% of households. These are individuals who already own large asset bases, giving them the ability to generate cash flow at scale without jeopardizing their liquidity. In contrast, most Americans rely on active income, that is, wages and salaries, for the vast majority of their earnings. The median retirement account balance for households aged 35 to 44 is under $60,000. At a 4% withdrawal rate, that's just $2,400 a year, which is far below a livable income. What's often marketed as universally accessible is actually structurally regressive. Capital income scales disproportionately with wealth. The more you have, the easier it becomes to earn passively. The less you have, the harder it is to even participate. Take affiliate marketing, for example. On paper, it's a pretty scalable model. Earn commissions promoting products online. But in reality, the people making the most are rarely the affiliates. They're the producers of these low-quality courses, supplements, or gadgets who build empires by incentivizing thousands of others to sell on their behalf. It's a funnel that rewards reach over substance and often ends with everyday creators burning trust with their audience to make pennies on the dollar. And ironically, many of the people trying to build passive income streams end up working harder than they would at a regular job, creating content, managing properties, marketing side businesses, without any of the stability, benefits, or legal protections that traditional employment offers. Now, I want to take a break here at this point to say, I don't think working harder is a bad thing. In some cases, you might be working harder, but your quality of life increases dramatically. Take this YouTube channel, for instance. This is such a unique challenge for me. It's forcing me to learn several new skills, constantly be critical of myself, and constantly work to improve the content quality and production of the videos I'm putting out into the world. While I may be working harder with no promise of ever earning any revenue, the satisfaction I get from posting a new video outweighs my desire to supplement my income. If it happens to generate income sometime in the future, great. If not, I'll continue to do this until I run out of things to say. But the reality is that passive income in its modern form often functions less like a shortcut and more like a full-time pursuit disguised as a way to hack the system. So what happens when an entire generation is sold on the dream of passive income, only to find out that it's neither passive nor guaranteed? Well, I think there's a growing sense of disillusionment. A surge in online side hustles, e-commerce ventures, and short-term rentals has led to oversaturated markets, reduced margins, and declining returns. Platforms like Etsy, Amazon, and Airbnb are seeing record user growth, but median earnings per user are falling. In real estate, the flood of amateur investors into short-term rentals has created gluts in key cities, prompting local governments to impose strict regulations. In digital markets, competition has become algorithmic, favoring incumbents with ad budgets, brand equity, or first-mover advantage. This creates kind of a paradox. The more people pursue passive income, the less passive and less profitable it becomes. As strategies become popularized, they lose their edge. Economic rents get competed away. From a policy perspective, this trend also risks worsening wealth inequality. When income is increasingly tied to ownership rather than labor, and ownership is concentrated at the top, the middle class gets squeezed. Without structural access to capital, most households are locked out of meaningful passive income channels. The broader implication is this: financial independence won't be achieved through passive income alone. It will require systemic shifts, higher real wages, affordable housing, access to low-cost capital, and robust social safety nets. In the meantime, passive income should be viewed not as a shortcut to freedom, but as a complex multivariable strategy that demands as much diligence and effort as any job or business venture. Guys, passive income will always be appealing because it taps into something fundamental, the desire for autonomy, security, and freedom from financial stress. But in the real world, income is never truly passive. It flows from capital, which flows from labor, risk, and time. The strategies that work are often slow, complex, and unpredictable. And the ones that are easy, like high-yield scams or over-leveraged property deals, usually aren't sustainable or morally justifiable. But that doesn't mean the pursuit is worthless. Building income streams outside of traditional employment is one of the smartest moves anyone can make if you go into it with clear expectations, financial literacy, and an understanding of market dynamics. The problem isn't the strategy, it's the oversimplification. And while I can understand how that might be discouraging, I hope you'll step back and take a look at that. If you're watching this video, I guarantee you are capable of bringing something new and creative to the world. But if you want it to grow into something, you have to take the risk and be willing to put in the work. So the next time you see a thumbnail promising $10,000 a month in automated income, remember this: there's no such thing as a free ride. And for most of us, hard work is still the price of admission. So what do you think about all this? I'd love to hear your take on some of the things I've talked about and what you think about our new set. If this helped you gain some perspective or gave you some clarity on how the system actually functions, please consider subscribing. It means the world to me. And until next time, have a good one.